Let us continue from where we left off. The next strategy that I am going to talk about is using of this carry trade. A carry trade is just another form of leverage. Return is enhanced by borrowing at a lower rate and investing the funds in an asset that will generate a higher rate of return. Now, the important point, let me cover the next point before I continue with it. In a stable upward sloping yield curve, borrow at lower short term rates to invest at higher long term rates. But there is a catch in this strategy. See, that is what I want to highlight. Otherwise, in the strategy in itself seems pretty elementary, that you borrow funds at a cheaper rate and invest it at a higher rate. But had it been so simple, everybody in the world would have done the same thing. The point is, there is an element of involvement of risk here, an enhancement of risk when you are investing in a bond or in an instrument giving you or likely to give you a higher expected return. I emphasize strongly, as I have been emphasizing throughout this course, that we do the analysis on a two dimensional framework, the risk and the expected return. The marketable securities have this property due to the interplay of millions of market players, that the risk and return are compatible. Return, higher the risk in a particular investment, greater would be the expected return, and vice versa. That plays, or that rule applies equally well when we talk about carry trade. Let me illustrate what I am trying to say. Let us say I borrow money at t equal to 0 for 1 year and I invest the money at in a 2-year bond. Right. Let me repeat, at t equal to 0, I borrow say 1000 rupees and for 1 year and I invest it in a 2-year bond. Now, at t equal to 1, there are two situations that are possible. Number 1, I liquidate my bond investment and I repay off the borrowing, so that if there is a profit, if there is a capital gain, very good. The other option is that at t equal to 1, I again borrow, or I roll over that borrowing for another 1 year and hold the bond until the maturity. So, let me repeat the problem. The problem is at t equal to 0, I borrow a certain amount of money, say 1000 rupees, and invest in a 2-year bond. Now, at t equal to 1, because my borrowing is for 1 year, I have to take one of the two situations. One is I repay off the borrowing by selling the investment in the market, 2-year bond at t equal to 1 year, or I roll over the borrowing for another 1 year and hold the investment up to its maturity. Now, the point here is, the catch here is that when at t equal to 1, I take up either of these two courses, either of these two approaches, I am exposed to risk, additional risk. If I try to liquidate the 2-year bond at t equal to 1 year, it would depend on the actual interest rates prevailing in the market at t equal to 1 year, not the projected rates that I had at t equal to 0, but it would depend on the actual interest rates that would prevail in the market at t equal to 1 year. I repeat, they may be different from the rates that were projected by me at t equal to 0 when I undertook this strategy. So, that is the additional risk. Interest rates are stochastic processes and their perfect prediction is obviously not possible. The second thing is, if I adopt the second strategy, the rate at which I am going to get the rollover, the rate at which this borrowing of 1 year is going to be rolled over from 1 year to 2 years would again depend on the market rates that prevail, unless of course I take a forward contract, which is not the issue here, which is not being considered here. So, in the absence of a forward contract, the rate at which my borrowing is going to be rolled over from 1 year to 2 years would again be a random variable, would again depend on market circumstances that prevail at t equal to 1 year. So, when you are taking up this kind of trade, you are also being exposed to additional risk, and the higher return that you anticipate is a consequence of this incremental risk that you are taking. So, the principle of risk return trade off is not violated here. Sell convexity, this is a very interesting strategy. I have been emphasizing again and again that the convexity correction is positive. The convexity correction is positive. That means what? That means if there is a parallel shift upwards or downwards in the interest rates, in the market interest rates, the correction due to convexity is always positive, it always leads to an increase in price. And that means what? That means the convexity, if you because the convexity is always to the benefit of the holder or always leads to an increase in price. That means what? That means the convexity is going to command a price in the market. So, if you are able to sell convexity, you would obviously make some profits out of it. How you do it? Let us just go through this. This means select bonds or a portfolio with lower convexity. Lower the convexity, the cheaper would be your investment, lesser would be your investment, because higher the convexity, higher is the benefit from an interest rate change, and therefore, higher would be the price or value of that investment. By itself, positive convexity is beneficial, that is what I mentioned just now. It means that if there is a large decline in interest rates, the increase in the bonds price will be greater than expected from duration alone. So, if there is a decline in interest rates, the price increases, but the convexity correction is an add on to the price that would have been worked out on the basis of using duration alone. And if there is a large increase in interest rates, the price decline worked out on the basis of duration alone would be reduced by the convexity correction. The convexity correction would operate opposite to the decline in prices. It would reduce the decline in prices that is worked out on the basis of duration alone. Thus, plus C magnifies the upside and reduces the downside of price movement due to changes in rates. The changes in rates have to be rather large. Now, this is an issue of magnitudes rather. So, notwithstanding the fact that the convexity correction is always positive, the important thing that we need to keep in mind is that the impact of this convexity correction is minimal, and in order that it be significant, the interest rate changes have to be quite large, because convexity is a second order correction in the Taylor series, as you know. That means, plus C has little impact on changes in price unless the rate change is significant. Of course, there is rarely any free lunch. Bonds or portfolios with higher plus C normally have low yield. So, that is the catch. That means what? That means if you are not expecting a significant increase in or decrease in interest rates, it would be better to take up or better to constitute a bond portfolio with lower convexity, because the convexity correction is not going to be material. On the other hand, by opting for a bond portfolio with higher convexity, you may be required or you may be actually sacrificing expected yield to significant extent. So, it is again a trade off. Higher convexity means lesser yield, higher convexity means greater positive convexity correction. So, similarly, lower convexity means lower correction in the price, but relatively higher yield in the portfolio itself. So, that is the trade off. Higher convexity means higher price correction, positive price correction, but lower market yield. Conversely, lower convexity means lower price correction and relatively higher yields in the bond portfolio. So, again we have a trade off here. The conclusion is that if the curve is expected to be stable, little change in interest rates, the convexity correction shall be having a minimal effect, and therefore, it is better that you sacrifice convexity, you have low convexity in your portfolio and make use of bonds which have low convexity, but higher market yields. Strategies for parallel shift in the yield curve. So far, we have talked about strategies that involve a stable yield curve. Let us talk about parallel shift yield curves. This is the formula that we all know, we are very familiar with, that is the duration convexity model for the percentage price change, and this is the duration correction and this is the convexity correction. If rates are expected to increase, decrease portfolio duration before this occurs to minimize the value lost. If rates are going to increase, naturally there would be a decline in the value of your portfolio. If you reduce the duration, naturally the decline would be less, because the change in bond prices or the percentage change in bond prices is proportional to duration. If you ignore the curvature of the curve, if you ignore convexity, then we can say that the percentage change in prices proportional to the duration. So, higher if there is an increase in interest rates, higher the increase in interest rates, greater would be the fall in the prices of the bonds if corresponding to a higher duration. Longer the duration, greater is the fall in the prices of the bond. Shorter the duration, lesser is the impact of a price of an interest rate change on that bond portfolio. So, if rates are expected to increase, decrease the duration, lower the duration, lower will be the price fall due to an increase in rates. Conversely, if rates are expected to decrease, increase portfolio duration, larger the portfolio duration, larger would be the positive impact of increase in prices due to a decline in interest rates. Of course, all changes in duration must be consistent with the portfolio constraints. Adjust convexity, that is another strategy. Greater convexity will increase the value gained. I have just talked about convexity in a lot of detail. Let us quickly recap through this. Greater convexity means what? Increase the value gained if rates decrease and decrease the value lost if rates increase. So, the price correction is always positive, it leads to an increase in price or the percentage price. The convexity effect will only be material, that is the catch. The convexity correction will only be material if the rate change is significant, because it is a second order correction, and it will involve accepting less yield, assuming that rational pricing of assets in the market. If you have two bonds A and B, both with the same cardinals except for convexity, bond A has lower convexity, bond B has higher convexity, then clearly bond B will command a relative premium compared to bond A if they have the same other cardinals. Strategies for non-parallel shift in the yield curve. The basic concept is simple. What is the basic concept? Determine the appropriate duration for the portfolio within that constraint of meeting target duration. Increase exposure to those points on the curve where rates are expected to show a relative decrease in level, because what will happen if the rate, if your expectation turns out to be correct, the rates will decrease at these points on the curve, and corresponding to these points on the curve, the because the lower rates would be used in computing the prices will increase, and if the portfolio value is concentrated around these points at which the rates are expected to decrease and the rates actually decrease, there would be significant value gain. Increase exposure to those points on the curve where rates are expected to show a relative decrease. Decrease exposure to those points on the curve where rates are expected to show a relative increase. Implementation, bullet versus barbell. The simplest way to implement this strategy is selection of a bullet versus a barbell portfolio. The bullet portfolio concentrates exposure. Now, this is important. The bullet portfolio concentrates exposure in the desired total portfolio duration point of the curve, denoted here as M for middle. The barbell portfolio concentrates exposure at shorter and longer points on the curve to achieve the same desired duration, but a laddered portfolio, I will come back to it in this in a few minutes. A laddered portfolio would distribute exposure more evenly along the curve between L and H. So, let me repeat, a bullet portfolio completely concentrates the exposure at the point of its duration, assuming that it is a 0 coupon bond. A barbell portfolio distributes the exposure between 2 points such that the bullet portfolio remains in the middle and the barbell consists of 0 coupon bonds, and a laddered portfolio is somewhere in between, where we have portfolios of maturities at different time intervals over the time interval between L and H. So, let me quickly read out the features of the laddered portfolio before we move forward. In a laddered portfolio, roughly equal par amounts are purchased and become due each year. In a laddered portfolio, roughly equal par amounts are purchased and become due each year. The same duration could also be achieved by concentrating all the holdings in a single middle duration, that is a bullet portfolio, or in a shorter and longer duration, that is the barbell portfolio. So, let me just illustrate it briefly. Let us say this is this is t equal to 0, let us say this is the point t equal to 0, let us say this is L, let us say this is L, let us say this is H, and let us say this is M. Now, a bullet portfolio will have a maturity of M and it will be 0 coupon bond, so its duration will also be M. A barbell portfolio will have a combination of L and H in such a way that the duration of the portfolio comprising of L and H is exactly equal to M. The combination of the durations of L and H, the barbell duration works out to exactly M, and however, of course, this barbell will have a higher convexity than M, as we have seen earlier. Then we can have a situation where we have portfolios having maturities at L plus 1, L plus 2 up to M, and then M plus 1, M plus 2 up to H. Assuming that these maturities are evenly spaced between L and H, then this is called a laddered portfolio, and again this will have a duration equal to M, and its convexity will lie between that of M, which has the lowest, and the barbell which has the highest. So, bullet, barbell and laddered portfolio all will have the same duration, but bullet will have the least convexity, barbell will have the highest convexity, and laddered portfolio will have a convexity in between. So, that same duration could also be achieved by concentrating all the holdings in a single middle duration, bullet duration, or a shorter and longer duration, barbell duration, a barbell portfolio rather. If all the three portfolios have the same duration, they all have roughly the same price sensitivity to a parallel yield curve shift. At least for small shifts, they will have same sensitivity. Of course, when the shift is significant, the convexity impact or the convexity effect would come into play, but that is only if the parallel shift is significant. With a laddered portfolio, the investor is diversified between price and reinvestment risk. Some bonds mature each year and can be reinvested if rates are high. This creates a form of dollar cost averaging over time. The ladder has less reinvestment risk in any single year versus the barbell, because the entire reinvestment of the barbell is going to take place at t equal to L. When the portfolio with the lower maturity matures, you will have to invest it for reinvest the proceeds of that portfolio for the period from t equal to L to t equal to M, when the bullet liability is to be repaid. The more distributed cash flows of the ladder compared to the bullet, please note that, not compared to the barbell, will provide greater convexity, benefiting performance for large changes in rates. So, bullet convexity is less than ladder convexity is less than barbell convexity. Advantages of laddered portfolio. The greatest practical advantage is natural liquidity, as some bonds come due each year. This is particularly significant if less liquid bonds such as corporates are used. The need to sell at large bid ask spread to meet cash flow need is reduced. Alternatively, these now near to maturity bonds would be treated as less risky collateral and could be used to borrow at favorable interest rates. So, even if you are not able to liquidate the bond in the market because the maturity is very close, you may be able to get loan against these collaterals at favorable terms. There is the broadest diversification of cash flow across time and the yield curve, hence less concentrated exposure to twists in specific points of the curve. In an upward sloping yield curve, this can also be desirable at each maturing bond is rolled over into the longest and highest yielding maturity used in the ladder. And that is provided, of course, that the yield curve structure is unchanged, the yield curve spectrum or the spectrum of spot rates is unchanged over the period of relevance. There is diversification between price and reinvestment risk. Regarding prices, some bonds mature each year. Regarding reinvestment risk, some bonds mature each year, so some proceeds will be reinvested at higher and some at lower rates. This creates a form of dollar cost averaging. The laddered portfolio will have more convexity than the bullet, a benefit if there are large parallel shifts. Further, the ladder will have lesser convexity than the barbell. Recall that the distribution of cash flows is directly related to convexity. So, because the distribution of the ladder is higher, the convexity because the distribution of the ladder is higher compared to the bullet, it has a higher convexity than the bullet, but because the dispersion of the barbell is higher than the ladder, the convexity of the barbell is higher than the ladder. The duration contributions and key rate durations of the bullet, ladder and barbell will also differ. So, the portfolios will respond differently to non-parallel shifts in the curve. The ladder will typically fall in the middle of such curve risk exposure, and this is an important point, that because although the durations constituted for the bullet, the ladder and the barbell are identical, they are constituted by different combinations of assets. So, when there is a change in the shape of the spot yield curve, they would respond differently, notwithstanding the fact that they have the same duration. Same duration would yield in same or approximately same percentage price changes, provided the shift in the yield curve is parallel. I repeat, is parallel. If the shift is not parallel, then the fact that durations are equal would not imply that the percentage price change is the same in each case, because the equality of durations does not mean that they are created by the same asset. In the case of the barbell, they are created by two assets L and H, and in the case of the ladder, they are created by a number of assets across the entire spectrum from L to H. However, in the bullet, they are created by only one asset. This differential in the constitution of equal duration portfolios will manifest itself as different price changes due to shaping risk, due to a change in the shape or structure of the spot yield curve. Example, selection of the curve strategy. Consider a portfolio with a benchmark that is laddered and has a duration of 10. The manager is considering three possible strategies. Bullet, 100% in securities with a duration of 10, the yield and convexity as 4.51% and 16.4%. You can see, as you see is very soon, the return is highest and the convexity is lowest for the bullet portfolio. So, expected return and convexity operate in different directions. Barbell, 50% in securities with a duration of 2 and 50% in securities with a duration of 18. For portfolio duration of 10, the yield and convexity are 4.3% and 24.7%. Compare it with 4.51% for the bullet. You have, in the case of the barbell, 4.30%, and then we have the ladder. Match the benchmark which has an equal distribution of 1 to 19 duration bonds. For portfolio duration of 10, the yield and convexity is 4.39%, higher than the barbell, lower than the bullet, and the convexity is 20.1, which is again higher than the bullet, which is 16.4, and lower than the barbell, which is 24.7. Now, let us see the various optimal strategies. Optimal strategy for a small and a very near term parallel upward shift in the yield curve. What happens in this case? In this case, there is no significant advantage for each strategy. They all have the same duration, and therefore, the duration effect will be pretty much the same in the case of the bullet, the barbell or the ladder, and the expected change in value for a parallel shift will be almost the same. Because the change is small, the convexity effect would be minimal, and as a result of which the advantage of the barbell will be very small. The bullet has a yield advantage, no doubt about that, but the barbell will have a small plus due to the highest convexity, because convexity is positive and it has a higher convexity. So, it will contribute to a slightly higher return due to the convexity effect, but that is neutralized by the higher yield of the bullet, and the ladder comes somewhere in between, and it closely matches the portfolio's benchmark duration distribution, but has no material expected return advantage in this scenario. Optimal strategy in the case of a large parallel and very near term upward shift in the yield curve. A parallel upward shift. Now, it is a large parallel upward shift. Large means we have to look at the convexity, and because if there is a large shift and if the shift is parallel, convexity comes into play very significantly and the convexity correction becomes relevant, and it is an upward shift. So, the interest rates increase, so the prices will decrease, and in this case the barbell will be the best strategy because it has the highest convexity. With a large increase in interest rates, the higher convexity of the barbell will produce the greatest cushioning of the price decline. So, that is what I mentioned. Optimal strategy for a large parallel downward shift in the yield curve over the next 12 months. Now, this is interesting. We are having a large, so convexity comes into play, parallel, so duration and convexity both come into play, and the shift is over the next 12 months. That is another important. There is no distinct advantage for any strategy. There are conflicting issues, they all have the same duration. So, as far as duration is concerned, they are equivalent more or less. The bullet has the lowest convexity, but it has the highest yield advantage over the next 12 months. The barbell has the highest convexity, but it has the lowest yield advantage, and as a result of which, although the convexity correction will operate in the positive direction, the yield, the intrinsic yield of the barbell portfolio is relatively lower. The ladder more closely matches the portfolio benchmark duration distribution, but has no material expected return advantage in this scenario. So, while the bullet has a yield advantage, it has lowest convexity, the barbell has the highest convexity and it has the lowest yield. So, these two relative extremes will tend to neutralize each other, since the shift is over the next 12 months, and yields, the consideration of yield is important. So, next is optimal strategy for an immediate steepening of the curve with short rates, duration of 1 decreased 50 basis points, no change in the intermediate rates, duration of 10, and long rates of 19 increasing 50 basis points. Now, here the barbell becomes the worst strategy and the bullet becomes the best strategy. Why is that? Let us try to. What he is saying is that the near term rates are decreasing. Now, when the near term rates are decreasing, the L component of the barbell will increase in price, but the L component of the barbell's increase in price will be small because it has a small duration, and the H, because the higher rates are increasing. You see, the long term rates are increasing, and now because the long term rates are increasing, the H component of the barbell will decrease in price, and that decrease in price is going to be significant. Why? Because it has a long duration. Larger the duration, larger is the percentage change in price. So, to that extent, the bullet will operate as the best and the barbell would operate as the worst, and the ladder would come somewhere in between. So, that is what is the analysis. With no change in the intermediate rates, it will not decline in value. The bullet will not decline in value. The others will decline in price. Why? Because the long term duration will have a greater price impact compared to the short term duration, and in the long term the rates have increased and therefore, the prices will decline and they have a longer duration. So, the price decline is also more, the price increase on the shortened side is relatively less, and this will operate both for the for the barbell to a larger extent and ladder to a lesser extent. Then we have the optimal strategy if the manager expects an immediate steepening of the curve with short rates decreasing 10%, intermediate rates increasing 40% and long term rates increasing 90%. So, in this case the bullet is best for the same reasons as we saw in the previous example. There is a steepening and that favors the bullet. There are also elements of parallel upward shift, but all strategies have the same duration and respond the same to a parallel shift, ignoring the small convexity effect, and this is the diagram corresponding to this particular problem. Then we come to optimal strategy for immediate flattening of the curve with short rates increasing 50 basis points, no change in intermediate rates and long rates increasing by long rates decreasing by 50 basis points. This means what? This means that the barbell will be the best. Why barbell will be the best? Because the long rates are decreasing and barbell's duration is longest. So, the barbells or the H component of the barbell will increase in price to the maximum and the L components decrease in price will be minimal because it has a smaller duration. So, in this case the barbell's price increase will be the best. So, we now talk briefly about convexity issues. As far as the impact of convexity is concerned, let me quickly recap, because a lot of strategizing is based on the issue of convexity. So, let me quickly recap in a sense whatever we have talked about in relation to convexity. It is the crux of whatever I have discussed in so far as interest rate risk management is concerned. All else being the same, it is beneficial to have greater convexity when large changes in rates are expected. The convexity will magnify value gain when rates decrease and cushion price loss when rates increase. However, there is likely to be a cost in the form of lower yield and increase from the portfolio. Increasing convexity, method 1, barbell versus bullet, we have discussed about it. So, I will quickly read through the slide, nothing more. To increase convexity, the more distributed future cash flows of a barbell will have higher convexity, but lower yield compared to the bullet. To decrease convexity, the more concentrated future cash flows of a bullet will have lower convexity, but higher yield. Generally, shifting between barbell and bullet structures have only a modest impact on convexity, holding total duration constant. Options have a much more dramatic effect on convexity. So, let me talk about that. Options on bonds. Please note that we are not talking about embedded issuer call options that exist on callable bonds. We are considering portfolios of bonds together with calls written on them. So, we are not considering embedded options which are a part of the bonds. We are not considering that. We are considering a portfolio of bonds, and within that bonds within that portfolio we also have call options written on the bonds which are a part of the portfolio. Now, long call options, obviously whatever the underlying asset may be, as the price of the underlying asset increases, the value of the long call also increases quite naturally, because long call gives you a right to buy the underlying asset at a predetermined price. So, if the price of the underlying asset goes above the exercise price, the greater would be the profit by exercising the call and selling it in the market. So, in a sense, the payoff from the option at maturity is S capital T minus K, and higher the value of ST, higher the value of the payoff, and higher the value of the option. So, long call options on bonds or on bond future contracts increase in value as the value of the underlying increases. So, long call value increases as value of the underlying increases. Thus, they provide increased upside for portfolio value as prices increase or rates decline. So, that more upside means more convexity. So, this is the bottom line, because as the prices of the bonds increases, the value of the option increases, and the combined portfolio consists of the bonds as well as the options on those bonds. The call options on that bonds, the value of that bonds increases, value of the call options increases, and therefore the value of the portfolio increases, and therefore means higher value accretion and therefore higher convexity. Long put options on bonds or on bond futures contracts increases in value as the underlying decreases. That is why because the put options give you a right to sell the underlying asset at a predetermined price. So, lower the price, greater is the value of the put option. Thus, they reduce the downside in the bond as bond prices decline or interest rise, and therefore, they also mean positive convexity. Thus, for increasing the convexity of a portfolio, buy call and or put options. To increase the convexity, the premiums paid to buy the options effectively reduce the yield earned on the portfolio. Sell call and or put options to decrease convexity. The premiums received from selling the options effectively increase the yield earned on the portfolio. Many portfolios have constraints that restrict the use of options. The third method is the case of bonds with embedded options. Callable bonds rather can be decomposed into an option free bond and a short call position. So, if rates decline, the price increases, but the price increase in the case of callable bonds is truncated, because the issuer, as soon as the price goes above the exercise price, will call back the bonds, and therefore, the investors' right to a higher price corresponding to a decrease in interest rates is curtailed, is truncated at the level of the exercise price. You will never get a price higher than the exercise price, notwithstanding whatever is the fall in the interest rates. Thus, the callable bond has diminished in value and has a negative convexity compared to the otherwise equivalent option free bond, particularly in the region where the embedded call option is near the money. Callable bonds obviously have a higher yield than straight bonds because of the short call option, because the issuer retains a right, and because the issuer retains a right, he has to pay a price for that in terms of the increased yield to the investor. So, this is the story regarding putable bonds, pretty much similar to what I have discussed about callable bonds. And with this, I conclude the portion that is on debt securities. From the next lecture, we will be starting a new topic. Thank you.